When you look at Singapore property developers, the headline dividend yields often hide two completely different business engines. On one side, you have direct property ownership, and on the other, you have asset-light fund management. If you care about whether your dividend is backed by hard rental income or fee collection, understanding this difference determines what happens to your cash flow when the cycle turns. Turning to the upcoming earnings calendar, both CapitaLand Investment and City Developments are reporting their first half results on the 13th of August. They sit in the exact same real estate sector, but operating underneath them are two entirely separate financial structures. Yet, when you strip away the management marketing, both face a remarkably similar pressure point regarding how comfortably their operating cash flow covers their debt. Looking at City Developments, or CDL, this is the traditional direct ownership model. They build residential condominiums, sell individual units, and hold commercial buildings and hotels directly on their own balance sheet. When property valuations climb, CDL reaps direct capital gains, but when interest rates stay high or asset values fall, their balance sheet absorbs that hit directly. On the other side of the sector, CapitaLand Investment, or CLI, has spent the last few years deliberately pivoting away from direct ownership. They raise capital from institutional investors, manage real estate assets on their behalf, and collect steady management fees. While CLI still holds balance sheet property, fee income is the central growth engine. To understand this in heartland terms, think of a coffee shop operator. CDL is the business owner who buys the physical coffee shop premises, taking the full risk if foot traffic drops or utility bills spike. CLI is the manager hired to run 10 coffee shops for other landlords, taking a slice of the gross revenue without carrying the property mortgage. There is a common retail assumption that an asset-light fee business is inherently safer than direct property ownership. But fee income relies entirely on growing funds under management and keeping institutional capital happy. If market sentiment sours and fundraising stops, a fee business slows down just as fast, just through a different operational mechanism. When you look at CDL's full-year FY 2025 numbers, net profit after tax tripled to 629.7 million Singapore dollars. Pre-tax profit doubled to 771.5 million Singapore dollars. But 473 million Singapore dollars of that came from a single one-off gain, the sale of their 50.1% stake in South Beach to IOI Properties. Strip that divestment out and the core operational numbers look far more ordinary. Looking at the residential property pipeline, CDL's first quarter property sales dropped 68% year-on-year. This slowdown happened because there was no massive flagship launch in early 2026 to match last year's 777-unit project. Their upcoming catalyst depends heavily on the launch of a 570-unit Lakeside Drive project, targeted for the third quarter of 2026. Examining CDL's balance sheet, net debt to equity sites at approximately 113%, which is heavy for a company exposed to direct property development cycles. To manage this, CDL launched a 2 billion Singapore dollar Perpetual Securities program in April to refinance existing loans, proving that managing leverage is an ongoing operational chore rather than a settled balance sheet question. Here is the core number every income investor must inspect: CDL's interest coverage ratio. Based on standard core operating income of 686 million Singapore dollars against interest expenses of 462 million Singapore dollars, their core operating coverage sat at 0.84 times. That means before counting the one-off South Beach divestment gain, core operations did not fully cover their borrowing costs. This does not mean CDL is in financial distress, as their hotel portfolio remains operationally healthy with revenue per available room up 4.3% in the first quarter. However, a business that needs asset sales to cover its annual borrowing costs is fundamentally different from a REIT or developer that covers its interest burden entirely out of recurring rental profits. Turning to CapitaLand Investment, their asset-light strategy is delivering on funds under management growth. supported by recent capital raises such as the $320 million Asia-Pacific real estate credit strategy. Their management fee stream is expanding, proving that institutional investors are still placing capital with their platform. However, CLI faces its own major drag, specifically in mainland China, which accounts for nearly one-third of their 20 billion Singapore dollars in non-current assets. Heavy revaluation losses of 439 million Singapore dollars in the second half of 2025 pushed CLI into a net loss of 142 million Singapore dollars attributable to shareholders for that half-year period. To counter this, CLI is accelerating divestments to convert direct China property exposures into fee-earning capital arrangements. On the debt front, CLI generated 580 million Singapore dollars in operating income against interest expenses of 296 million Singapore dollars, giving them an interest coverage ratio of 1.96 times. While safer than CDL's core coverage, it remains tighter than many investors expect from an asset-light manager. Most retail investors assume a fee-collecting business model operates with massive stress-free interest buffers. In reality, CLI's interest coverage cushion is surprisingly close to direct owners, proving that asset-light is not a guarantee of safety, but simply a trade-off between fundraising momentum and China exposure versus property launch timing. When both companies report on the 13th of August, do not get distracted by headline profit numbers. For CDL, the question is whether underlying operating profit, stripped of one-off gains like the South Beach sale, finally covers interest more comfortably, and whether Lakeside Drive and any Woodlands launch actually reverse this year's sales slowdown. For CLI, the question is whether fee income and funds under management growth are outpacing the China drag, and whether that revaluation pressure has genuinely stabilized or is still working its way through the books. Here is the thing both stories share underneath the different mechanics. Owning the building and managing the money are not two different risk levels. They are two different sets of pressure points, and August the 13th is where we find out which pressure point is winning for each of them. That is the real test of this entire comparison. Not which model sounds safer on a slide, but which balance sheet is actually holding up when the results land. When both companies report on the 13th of August, do not get distracted by headline profit numbers. For CDL, check if underlying operating profit covers interest without needing asset sales. And for CLI, check if fee income growth is outracing China revaluation write-downs. Iggy's elite investors get zero-day access to full forensic breakdowns, the complete red zone watch list, and valuation cheat sheets the moment setups go live. I am Iggy, forensic investor ranked 8th on Tiger Brokers among Singapore retail investors and your guide through the SGX market jungle. If you want the full breakdown before the free version drops, Iggy's elite investors get zero-day access, link in the description. Get everything. Zero-day access on both platforms, full red zone watch list, institutional grade cheat sheets with Iggy's elite investors, 12 Singapore dollars per month.